Welcome to Accounting 101 once again. This video, we're going to be going over the solutions to the assignments for chapter 11 and 12. Let me get some more lighting on here so we're not in the dark. Get away with it in the daylight without these. All right, hopefully that's a little bit better for you folks. Chapter 11, review questions 1 through 4, 7, 12, and 13. Review question number 1. What are the three main characteristics of liabilities? This was found at the beginning of the chapter, and if you remember them, good. If not, you can go look them up or write them down now. They occur because of a past transaction or event. Number 2, they create a present obligation for future payment of cash or goods or services. And third, they are an unavoidable obligation. Review question number 2. What is a current liability? Provide some examples of current liabilities. Current liability must be paid with cash or with goods or services within 1 year or less, or the entity's operating cycle, whichever is longer. Examples of current liabilities would include accounts payable, notes payable that are due within 1 year, current portion of long-term debt, salaries payable, interest payable, sales tax payable, and all those other nice things. Unearned revenue you could throw in there as well. Number 3, how is sales tax recorded? Is it considered an expense of a business? Why or why not? Well, sales tax is recorded as a liability. A business collects sales tax on behalf of a government entity, a government jurisdiction, the state or county, and they take custody of it from the customer, but it doesn't belong to them. It doesn't belong to the business. It belongs to the government. So you collect it from the customer, you hold it, and then periodically send it in. So it's a liability. It is not an expense of the business, but rather a current liability. Review question. Unearned revenues arise. Well, shades of chapter 3, huh? An unearned revenue is a situation where we get paid before we deliver the goods or services. Okay. So we either, when we accept payment from a customer, are forming a contract to perform services or deliver goods. And if we don't we're liable to deliver those goods or services. And if we don't, we have to refund the customer their money. So it's a liability until the earning process is complete. And that is delivering the services or delivering the goods. Then we fulfill our side of the contract. Number 7, review question number 7. What's the difference between gross pay and net pay? Gross pay is your total salary or wages, commissions, bonuses, and those type of things during a pay period or a given stated period of time. The net pay is the amount that the employee actually gets to what they call take home. There's a whole bunch of withholding items that we saw during the chapter when we discussed the chapter. Things like federal income tax, state and local income taxes, Social Security taxes or FICA taxes, one of which is Social Security, one of which is Medicare. Contributions to a savings, to the credit union, to a savings account, Christmas club, vacation club, contributions to various charitable organizations can be deducted from your paycheck. It can even go so far as to have child support withheld under a court order. It is taken out of the employee's money and sent to where it needs to go. Health insurance is a common withholding amount where more and more employers are having their employees contribute to the cost of the healthcare coverage provided. Review question number 12. Bear with me while I try to scroll down this electronic textbook, which is a little bit more difficult with this publisher than it is with some of the other ones I have. Okay, what are we up to? Review question number 12. Did we? Yeah, okay, net paying. When do businesses record warranty expense and why? Well, when is the revenue generated that is going to cover the cost of the warranty? That would be the sales price. Okay. So the expense should be matched against the revenue. So it should be recorded at the time the product is sold. A kick out of a former vehicle I had, we had a couple things, minor things had to be adjusted after we took delivery. And it was a 46-mile round trip to the dealership from where we lived. And, you take it back the second, third time for the same thing, you get a little bit irritated. And the service manager said, "Oh, well, you're not happy. It's covered under warranty." And I informed him that the cost of that warranty is in the purchase price of the vehicle. So, yeah, you think it's free, but it's not. The customer is paying for it. Very few things in this life are free. Question 13. Well, one more thing on 12. Why do we do it at the time of the sale of the product? Is because we want to preserve the matching concept, match the revenues and expenses in the same period. 13. What is a contingent liability? Provide some examples of contingent liabilities. Contingent liability is a potential liability that is dependent on a future event occurring. Okay. For contingent liabilities to be paid, some event, the contingency, must happen in the future. Two classic examples are if you co-sign a note for another party and the other party doesn't pay, the bank will come to you. You're going to be contingently liable to make good if the original signee, the principal borrower, defaults on the loan. Another example, classic example, would be a lawsuit. And it's not part of this question, but just to serve as a reminder, the way we treat it depends on the likelihood of that contingency occurring. 3 possibilities we recognize: remote, reasonably possible, and probable. If it's remote, we don't have to do anything. If it's reasonably possible, we have to disclose it in the notes to the financial statements. If it's probable and can be reasonably estimated, then we do an entry to record the expense and the liability, the corresponding liability. If it is probable, but we can't estimate the amount, then we just disclose it. All right, let's get over to the short exercises now. Number 2. Take a while for this electronic textbook to turn pages. There we go. All right, I've got to scroll down to short exercise number 2. Please bear with me. Recording sales tax. On that's 3. On July 5, Williams Company recorded sales of merchandise inventory on account $55,000. The sales were subject to a sales tax of 4%. On August 15th, Williams Company paid the sales tax owed to the state from the July 5th transaction. Requirement: 1. Journalize the transaction to record the sale on July 5. Ignore cost of goods sold. All right, so what we have to do there is, it's on account, so we're going to debit accounts receivable. And credit sales or sales revenue, and sales taxes payable. Now the sales, I'm going to put this piecemeal and explain it. So there we have the entry, a credit to the sales account to record the sales. Now, how much did we get from the customer? The $55,000 promise to pay us, plus the 4% of the tax, which is $2,200. 4% of 55,000 is 2,200. So we put it in the sales tax payable. It's a liability. It doesn't belong to the business. It doesn't belong to Williams Company. It belongs to the government. So then the accounts receivable was going to be debited for a total of $57,200. There it is there. There's the debit up top. That $57,200 is the $55,000 in sales plus the $2,200 in sales tax collected on those sales. So when they get it in, we have to send it off to the government. And I put a date on these. It was July 5th, and now it's August 15th. So we're going to send a check in to the sales tax people, and that's going to satisfy that liability that we recorded on July 5th when we debited accounts receivable for the sale and the sales tax payable. And there's what the entry would look like. A debit to sales tax payable because we're satisfying that liability that we incurred in July, and a credit to cash because we have to send them a check. All right, next one is short exercise 3, right underneath it. Scroll down a little bit. Okay. June 1, Movies Online collected cash of $63,000 on future annual subscriptions starting on July 1. So they're getting paid ahead of time. So this is going to be a unearned revenue, which is a liability. Just let me label this here so when I put it up, you'll know what it is. Short exercise F 11.3. Requirements. Journalize the transaction, record the collection of cash on June 1. Okay. So we put the date down, June 1. We're collecting cash. Cash is an asset. So to increase it, we're going to debit cash account for $63,000. And we're going to credit what? It's not sales because we haven't earned it yet. So we have to put it in unearned revenue, a liability account. We took their money and we haven't done anything yet. We're not going to do anything till July 1st when we start allowing them to look at the movies online. There's the entry. Debit cash, credit liability, unearned revenue. Now, requirement number 2, journalize the transaction required at December 31, the company's year end, assuming no revenue earned has been recorded. So again, this would be a adjusting entry on December 31 to recognize that a half a year has passed by on those annual subscriptions. So we are now entitled to record half the revenue. Well, half of 63,000 is 31,500. So we know those are going to be the amounts being debited and credited. We just have to figure out which accounts are being affected here. Well, originally we put it in an unearned revenue. After 6 months comes and goes, we have earned half of that amount. So we're going to reduce the liability unearned revenue and put it in a revenue account, an earned revenue account. Subscription revenue or sales. Next one we have is short exercise 7. Okay, it's on the same page, so that's a good thing. What do we have here? Lily Carter works for JDK all year and earns a monthly salary of $12,300. There is no overtime pay. Lily's income tax withholding rate is 15% of gross pay. In addition to payroll taxes, Lily elects to contribute 4% monthly to the United Way. JDK also deducts $200 monthly for co-payment of her health insurance. As of September 30th, Lily had $125,100 of cumulative earnings. Now, what they don't mention up there, but you have to be cognizant of, is the FICA tax and the two portions of the FICA tax. Short exercise 11.7. So let's figure out the amounts involved before we attack the entry. They say computer net pay for October, so we'll do that first, and then we'll do the journal entry. Okay. So first thing we have to know is in this edition of the textbook, there's a limit on the Social Security, the Old Age Survivor Disability Insurance section of the FICA tax of $132,900. It's currently higher than that. In fact, it gets indexed for inflation each and every year. Okay, this is the max amount subject to Old Age Survivor Disability Insurance, FICA. Yeah, $132,900. Let's see what it says here that she had $125,100 earned as of September 30th. So she's close to the limit. So that would be $7,800 of her $12,300 that is going to be subject to the Social Security portion of the FICA tax. Okay, and that is 6.2%. And if we do the math there, that's $483.60. Okay, so that's how I calculated it. Took the limit, the 132,900. I'm looking at it backwards in the monitor here, the screen. Subtract her earnings to date from the beginning of the year through the end of September, because we're dealing with October here. Subtract that $125,100 that she's earned, and she's only $7,800 away from the limit. So we're going to tax that $7,800 at 6.2% for her Social Security tax. The Medicare tax has no limit, has no cap on it. So that's going to be subject to $12,300 is going to be subject to her federal income tax of 15%, the Medicare tax of 1.45%, and her United Way contribution of 4%. So her federal withholding is going to be $1,845. Her Medicare tax is going to be $178.35. I'll show you these once I get the United Way. 4% of her 12,300. 492 even. Okay. So we had to do an adjustment with the Social Security portion of the FICA. For the Medicare, 1.42, not. It's on the full 12,300, as is their federal income tax, as is their United Way contribution. Then additionally, it says that she had a $200 copay for her health insurance. $100. Okay. So I don't know if hopefully this will show up here. So here's all the withholding amounts we've computed for Lily. Her old age survivor disability for her FICA, 483, 60. Her withholding, federal income tax withholding of 1,845. 178.35 is her Medicare tax. 4% for the United Way, 492, and then the $200 for the health insurance. So her net pay would be her $12,300 gross pay less all these adjustments or withholding amounts. Okay. I'm not going to have enough room to put it on a different page here. All right. Our gross pay is $12,300 for October. Then we're going to have less Fed income tax withholding. Less FICA, old age, survivor disability, and FICA Medicare. And then health insurance. And then her United Way contribution. Get these listed here. Withholding 1845. Old age 483. 60. FICA Medicare 178. 35. Health insurance a flat 200. And her United Way 4%, $492 even. Okay, so there's all the things we computed and listed nice, and we subtract those from her gross pay to get her net pay. Those deductions would total $3,198.95. And that will give her net pay of $9,101.05. Now, requirement number 2. Screen went dark. I hit the cursor and it moved. Oh. Journalize the accrual of salaries, expense, and payment related to the employment of Lily Carter. All right, so October 31st. Salaries, expense. $12,300. One of the few times we're using pennies. Now, all we have to do is set up payables for all those withholding amounts from her gross pay. Go right in order. Fed income tax payable. 1845. FICA, old age survivors disability component, tax payable. 483. And just let me list them all and then I'll hold it up to the screen. FICA tax Medicare payable. Health insurance payable. United Way payable. And salaries payable. $178. 35. 200. 492. And her net pay of $9,101.05. Here's the entry to record the salaries expense. Now the payment to Lily Carter. Simple as that. Okay. Moving on, we now go to short exercise 11. All right, what do we have here? Is Trail Runner guarantees its snowmobiles for 3 years. Company experience indicates the warranty cost will be approximately 5% of sales. Assume the Trail Runner dealer in Colorado Springs made sales totaling $600,000 during 2024. The company received cash for 20% of the sales and a notes receivable for the remainder. Warranty payments total $10,000 during 2024. Okay, so short exercise 11-11. What do they want us to do? Record the sale, warranty expense, and warranty payments for the company. Ignore the cost of goods sold. All right, so we're getting cash, and that was 20% of $600,000 or $120,000 of the $600,000. The other portion was notes receivable. That would be $480,000. And sales revenue, picking up the credit. All right, now we have to do the warranty. That was to record the sales. Record the warranty. Warranty expense. And estimated warranty payable. Are the accounts we're going to be using. And the amount was estimated to be 5% of sales. Well, 5% of 600,000 would be $30,000. Now we had claims of $10,000. So that'll go against the liability we just recorded, estimated warranty payable. And a credit to cash. Now, requirement number 2, assume the estimated warranty payable balance is 0 on January 1, 2024. Post the 2024 transactions to the estimated warranty payable account, T account. At the end of 2024, how much is in the estimated warranty payable? How much in estimated warranty payable does the company owe? Well, let's start the T account here and call it estimated warranty in 1/1/2024, and that has 0 balance in it. During the year, we put $30,000 into that account. And that would have been at various times. That's just a summary amount. Every time we sold a snowmobile, we would record the sale and record the estimated liability on it, on the warranty. And then we had, during the year, we had claims, warranty claims during the year of $10,000, which leaves us a balance of $20,000 at the end of the year. Meaning, and that $20,000 is to cover, it's a 3-year warranty. So in year 1, the year of sales, we had $10,000 worth of claims. Years 2 and 3, probably going to have more. Well, hopefully it's going to stay with our estimate of a total of $30,000. We have $20,000 left more. We are liable for another $20,000 in warranty claims based on the $600,000 in sales. And number 12. All right. Well, I guess I could put it down on paper. Contingent liabilities. We have Freeman here. Freeman Motors motorcycle gang had the following contingencies. Short exercise 11-12. Okay. A. Freeman estimates that it is reasonably possible, but not likely, that it will lose the current lawsuit. Freeman's attorneys estimate the potential loss will be $4.5 million. Okay. So reasonably possible, it requires disclosure. B, Freeman received notice that it was being sued. Freeman considers this lawsuit to be frivolous. Well, in that case, let's assign it the likelihood of happening as being remote. So we don't have to do anything. And C, Freeman is currently the defendant in a lawsuit. Freeman believes it is likely that it will lose the lawsuit and estimates the damages to be paid will be $75,000. Since they can reasonably estimate the amount and it is probable, we have to record the liability. And corresponding expense. And disclose it. In item C, if it wasn't able to be estimated, we would just be required to disclose it. So you can see there, A, all we have to do is disclose it. B, we don't have to do anything because it's remote. A, it's only reasonably possible. In C, it's probable, likely to happen, and we have a reasonable estimate of the amount. So we will record the liability and the corresponding expense and also disclose it. If we couldn't estimate the amount, then we would only disclose it. And that does it for chapter 11. So now we can move on to chapter 12. Please bear with me while I try to change the pages of the chapter in this electronic textbook. Come on. Okay. Chapter 12, we have to do review questions 2, 5, 6, 7, 9, 10, 12, and 13, and 3 short exercises. All right. So, review question number 1. Where is the current portion of notes payable reported on the balance sheet? Oh, I'm sorry, that's number 1. Well, we can answer it anyway. That would be under current liabilities. Even though it's note payable, it's current, it would be a current liability. 2, what is an amortization schedule? An amortization schedule shows how much of each loan payment is attributable to repaying the amount borrowed, the principal, and how much of it is applicable to the interest. Okay. It also shows the beginning and ending balances, an amortization schedule. 5. What is the difference between the stated interest rate and the market interest rate? Well, the stated interest rate is also known as the face rate of interest. The stated rate or face rate of interest is the amount of interest that the bond that is printed on the bond, printed in ink on the bond. Okay. The market rate of interest is the rate available in the open market. The stated rate or face rate of interest printed on the bond in ink is going to be consistent for the life of the bond. That is how they compute the interest payment. The market rate of interest, as we've discussed in class, fluctuates. It goes up and down. And because of that, the value of the bond is going to go up and down. So the face value is the market value of the bond is going to change relative to the face value of the bond as the interest rate changes, either higher or lower. Market rate of interest is what investors get in the marketplace. It varies constantly. That was 5. Yeah. 6. When does a discount on bonds payable occur? Well, that occurs when the bond issue price, when they sell the bonds initially, when the proceeds from the sale of the bond are less than the face value, and that is due to the fact that the market rate of interest is higher than the face rate of interest on the bonds. 7. When does a premium on bonds payable occur? Well, you can determine that easily by looking at the initial sale of the bonds, the initial issuance of the bonds. If the proceeds of the sale is greater than the face value, the bonds are selling at a premium. And that is due to the fact that the bond, the face rate or stated rate on the bond, is higher than the current market rate of interest. The discount and premium on bonds is a mechanism by which the market forces bring the interest rate on the bonds. Think of this as a teeter-totter. If it's higher or lower, it brings the actual yield on the bond in line with the market rate of interest. And that is done by changing the market value of the bond. You can't change the face value because that's what you're going to have to pay at maturity, and that's printed on the bond. You can't change the stated or face rate of interest on the bond because that's printed in ink on the bond. The two things that are subject to change are the market rate of interest and the market value of the bonds. Current market value. All right. 7. Oh, that was 7. 9. Why should a company choose to issue bonds instead of issuing stock? Why would a company? The interest you pay on bonds to the bondholders is deductible for income tax purposes. So, in fact, it reduces your cost of financing, your cost of borrowing, because you'll want to look at it net of tax effect. Also, issuing bonds does not dilute ownership stakes. So if the owners of the company don't want to allow any new owners in and thereby dilute their ownership percentage, they will issue bonds. Additionally, earnings per share will potentially increase by issuing bonds instead of selling shares of stock, because earnings per share, earnings are the same. If you sell more stock, you have more shares outstanding, so the denominator would increase, the numerator would be constant, thereby your earnings per share would be lower. 10. What is the carrying amount of a bond? Or book value, interchangeable terms there. The carrying value of the bond is the bond payable minus any applicable discount on bonds payable, or adding any unamortized premium on the bonds payable. As we demonstrated in class, when we're amortizing the bonds, depending on whether it's a discount or a premium, it doesn't matter. We need to fully amortize the discount or the premium over the life of the bond. So at the maturity date of the bond, the book value is equal to the face value. Chapter 12. That was number 10. Review question 12. All right. What type of account is discount on bonds payable? What is its normal balance? Is it added to or subtracted from the bonds payable account to determine the carrying amount? Well, discount on bonds payable is a contra account to the bonds payable, so we could call it a contra liability account. If a liability account has a normal credit balance, the contra account to it would have a normal debit balance. So it would be subtracted or netted against the bonds payable account to determine the book value or carrying value. 13, the same question, but dealing with the premium. What type of account is premium on bonds payable? What is its normal balance? Is it added or subtracted from the bonds payable account to determine the carrying value? The premium on bonds payable is an adjunct account, meaning it's added to the bonds payable account to determine the carrying value or book value of the bonds. So it has a normal credit balance. The bonds payable has a credit balance, so anything that increases it, book value, would also have a credit balance. Credit and credit, you add them. Credit and debit, you net them. Okay, so a premium on bonds payable would be added to the bonds payable account to determine its carrying value or book value. Okay. Well, 13, that was it. Now we can move on to the short exercises. Clipboard ready here. What we have? First one is number 3. Page, why does that do that? I've got to turn the page. It usually takes 3 to 4, sometimes 5 seconds. What are we doing here? Number 3. Okay. Determining bond prices. Bond prices depend on the market rate of interest, stated rate of interest, and time. Determine whether the following bonds payable will be issued at the face value, at a premium, or at a discount. And they give us 4 scenarios here. The first one, A, lowercase a, says the market rate of interest is 8%. Idaho issues bonds payable with a stated rate of 7.75%, 7.75%. Okay, so the market rate of interest is 8%. The bonds are paying less than that. Who's going to buy our bonds at face value and get 7.75% when they can go to the market and get 8%? No one. No smart investor will do that. No prudent investor will do that. Unless we do what? Sell the bonds at a discount, and that discount would be of a magnitude that is necessary that the actual yield on the bond would equal the market rate of interest of 8% in this case. So the bonds would sell at a discount because the rate printed on the bond, the stated rate or the face rate, is less than the market rate of interest. Situation B, Austin issued 9% bonds payable when the market rate of interest was 8.25%. Well, think about what that would do. Would people be going to the market and get 8.25%, or would investors favor our bonds that are paying 9%? The latter. The investor is assumed to be a prudent, rational person, and they're going to try to maximize their yield. So they'll buy our bonds. Well, when people are leaving the market and coming to buy our bonds, we can charge a premium. And the premium would be to the magnitude that it would equate the market rate of 8.25%. Again, think of that equilibrium, the teeter-totter or seesaw, where the market value of the bonds, and again, that would be the bonds payable at face value plus a premium or less a discount is a mechanism whereby the actual yield on the bond will approximate or equal the market rate of interest. Situation C, Cleveland's Cars issued 10% bonds when the market rate of interest was 10%. Well, in that case, the bonds will sell at face value because the market rate of interest and the stated rate or face rate on the bonds are the same 10%. Finally, item D or scenario D, Atlanta's issued bonds payable that pay the stated rate of interest of 8.5%. At issuance, the market rate of interest was 10.25%. So our bonds are paying less than the market rate of interest, so we're going to have to sell them at a discount so that the yield will be equal to what investors can get in the market. So recapping, A would be sold at a discount, B would be sold at a premium, C would be sold at face value, and in D, they would be selling at a discount. 3-5, determining bond amounts. Savvy Drive-Ins borrowed money by issuing $3.5 million of 9% bonds payable at 99.5. The price of bonds are always quoted as a percent, and they don't put a percent there, but 99.5 means 99.5%. So these bonds, interest is paid semi-annually. Okay. Requirement: how much cash did Savvy receive when they issued the bonds payable? Well, let me get this on paper here for you. Short exercise 12-5. And we had $3.5 million worth of bonds, their face value, which is also the maturity value. And they sold at 99.5, so 0.995. There I have it set up. And if you do the math, plug that on your calculator, you will get what they sold for, or the proceeds on the sale of $3,482,500. So at maturity, Savvy Drive-In is going to have to pay the bondholders the full $3.5 million of the bonds. That's their face value. That's their maturity value. So the bonds are probably paying a little lower rate than the market rate of interest. So they sold not at full face value, but at 99.5% of face value. Okay, so that would be the proceeds on the sale. 99.5% of the face value of $3.5 million, or $3,482,500. Put that up once again. And I'll read requirement number 2. How much must Savvy pay back at maturity? I answered that when I was talking about part A. They'll have to pay the full face value of the bonds, $3.5 million. Okay, these bonds are selling at a discount, a slight discount, 0.5%. How much cash interest will Savvy pay each 6 months? Every 6 months. Well, they're using the straight line method here. So how much will they have to pay? Oh, it doesn't matter whether it's straight line or effective interest rate. We're talking about the payment, not the interest expense. The interest payment is always, we'll put the formula down here and then we'll plug the numbers in. Interest payment is the face value times the face rate of interest times the portion of year. Okay, so interest payment is the face value of the bonds times the face rate of interest times the portion of the year. They say they pay in every 6 months, so that's half a year. So the face value of the bonds is $3.5 million. Face rate of interest was 9%. So I'll go 0.09 and then by 0.5 for half the year. 1,500,000. Oops. That equals $157,500 every 6 months. That's the payment of interest alone. The bondholders are going to get that every 6 months. And then at the end of the life of the bond, it didn't tell us how long these bonds were for. They're going to have to pay the bondholders $3.5 million to redeem the bonds. Okay. Number 6. Well, you know what? It doesn't ask it for here, but let's throw it up here just for our own edification. Let's record the sale of the bonds. So Savvy Drive-In, the proceeds, they're going to get $3,482,500. So I'll debit cash for that amount. I'm going to skip a line and put down the bonds payable that are always recorded at their face value, which in this case is $3.5 million. And we can see from that partial entry, 2/3 of it, that we have an imbalance between our debits and credits, right? So we have to add in $17,500 to make that balance. And let me just check that 3 million. Yes. So the difference is 17,500. The normal balance of the bonds payable, liability accounts are credit. The balancing figure is a debit. So it's going to have to be what? A discount on bonds payable. And a couple other ways you can do it or confirm it for yourself. Well, they didn't tell us what the market rate of interest is, so we can't do that. We can base it, though, on the fact that they sold at 99.5 or 99.5, so they're selling below face value, so they're selling at a discount. So the market rate of interest must be greater than 9%. Not a whole lot greater, because that's not a very big discount on $3.5 million. All right, that was 12.5. Now let's take a look at 12.6, where we're going to do some entries, journalizing bond transactions. I'll label this short exercise 12-6. And skip it there a little bit. What do they want here? Power company issued $1 million of 5% 5-year bonds payable at face value on January 1, 2024. Interest is paid semi-annually on January 1 and July 1. Requirements 1. Journalize the issuance of the bonds payable at January 1, 2024. Journalize the payment of the semi-annual interest on July 1, 2024. So they issued them at face value. What does that mean? That means the rate of interest, the stated rate of interest on the bonds, or the face value of interest on the bonds of 5%, and the market rate of interest are equal. So the market rate of interest is also 5%. So we don't have to worry about any premium or discount here because they sold at face value. So how much would we get if they sold $1 billion worth of bonds at face value? We would get $1 million. So we're going to debit cash for $1 million and credit bonds payable, the liability account for $1 million, respectively. Debit to cash, $1 million. Credit to bonds payable, $1 million. Okay, and that was 1/1/2024. Now, interest on July 1, 2024. Okay. Well, what's the formula? Interest payment, I have it up here for the last one. It's the same formula, but the numbers change. So we're going to put $1 million here and 5%, and again, half a year. Oh, I'm going to do the entry and then I'll show the calculation underneath. Interest expense, and we're going to pay the bondholders cash, and it is $25,000. And let me just get the computation down here so you can see it under the entry. $1 million face value times 5% times half, 0.5 for 6 months out of the year. Okay, there's the entry, and here's the computation. $1 million times 5% times half of the year. I think that's, do we have one more here? Yeah, number 7. Okay. Short exercise 7, generalizing bond transactions. Okay, let's see what we have here. Short exercise 12-7. Owen Company issued $110,000 of 11% 10-year bonds payable at 94 on January 1, 2024. So they're selling at a discount, 94% of face value. Interest paid is annual January 1. Okay. So what do they want us to do? Journalize the issuance of the bonds on January 1, 2024. So we're getting cash. How much cash are we getting? I'll write it right after it. $110,000 face value of the bonds times 94%. So we're getting $103,400. Now the bonds, I'm going to skip down here and again do this piecemeal so you get a better idea of what's going on here. Bonds payable are always credited at their maturity value or their face value. In this case, $110,000. So once again, we see that the debits and credits are not equal, but they must be. And we have more in credits, so we've got to add something to the debits there, and it's going to be $6,600. And it's going to be discount on bonds payable. Why do I know it's a discount? Well, they told me that they sold at 94% of their face value. They're selling less than face value. It has to be a discount. All right. July 1st, payment of interest and the amortization. And they're saying to use the straight line method, so there's no calculations have to be done here. It's the only place they use it is in textbooks. So the interest expense is calculated how? In this case, the payment Again, we're going to piecemeal this thing. The cash payment is always the face value times the rate of the bond, which is 11%, 0.11, times half a year, because we're dealing with every 6 months. So the cash payment being made is $6,050. All right, and there's a calculation right after the cash being credited. $110,000 a bond, 11%, half the year, $6,050. Now we're going to amortize that discount on bonds payable, and they're using the straight line method here. So I'll do the calculation a little bit below. Just let me write this down here. All right, so the discount, total discount when we sold the bonds was $6,600, right? Right down here. Now, it's a 10-year bond, and they pay interest semi-annually. So how many interest payments are they going to do? 20 interest payments. So I divide that $6,600 discount by the 20 interest payments, and that's the straight line method for amortizing the discount. What that does is charge an equal amount each interest payment, which is not the correct way of doing it. They only do it in textbooks. So that works out to $330 of discount amortization every interest payment, every time interest is paid. Okay, so there's the calculation there. The total interest, or the interest payment, $6,600. The total discount, $6,600 divided by 20 interest payments, 330 or 303? Yeah, 330. 330 every time we pay interest. Now, what does the payment, or I'm sorry, what does the amortization of discount do to the interest payment? I'm sorry, the interest expense. It increases it. And again, look what we have set up. You can't go wrong because it's all logic. All we need is a number up here for the interest expense. It's got to be the combination of these two credits, right? Or $6,380. These two, add them together, you get $6,380. And again, logically, what's happening? We sold them at a discount, so the interest expense has to be greater than the interest payment. If it's a premium, it's just the opposite. The interest expense will be less than the interest payment. The interest payment is always a face value and the face rate of interest, prorated for the portion of the year. The interest expense, this way is a straight line method. By rights, it should be the effective interest rate method, which is the carrying value of the bonds times the market rate of interest times the portion of the year. So that was it for chapter 12, 3, 6, and 7. Okay, so that's it. All right, just about an hour and 10 minutes. Very good. I will take a little break, and then I will do a tape going over the example in the textbook in the appendix using the effective interest rate method. And I will use a table identical to the one that's going to appear on the final exam. So you guys can practice that up, and we'll do the journal entries that are going to be very reflective of what's on the final exam. Okay, so that's it for the solutions for chapters 11 and 12. And when I send it out, I'll send out another tape that'll probably be about 40, 45 minutes in length. and be very similar to what's going to be on the final exam, except it's going to be a premium or discount. It's going to deal with bond amortization table. As I said in class, I will label the columns in the amortization table and give you the formula of how to compute them. And all you have to do is do a little bit of math, and that's going to be your basis for doing the entries. And entries, by now you should know them. And again, what are they going to be? Issuing the bonds, amortizing the discount, and paying the interest, and recognizing the interest expense.